One of the key questions you ought to be addressing at this time of year is, will there be a Santa rally? Now, what's a Santa rally? A Santa rally is when the stock market goes up sometime around year end. Some people believe there are good seasonal supports in place that drive markets higher ahead of December 31, and as a result, they often look for excuses to buy the market sometime shortly after Thanksgiving and try and participate in that Santa rally. Now, of course, there are lots of reasons why at different times of the year seasonality might kick in, and that certain months might be stronger in the market than other months. And what I wanted to do in this video is just focus upon the month of December and look at just over 20 years worth of data going back to 1999 and say, is this a good time of year to be buying stocks? What does the historical data tell us? Now, of course, one very important thing to remember is that you'll see on any investor's disclaimer that history is not necessarily a guide to the future, and this applies particularly in these circumstances. Just because the markets on average may have rallied over the last 20 years in December doesn't mean necessarily it'll do so in any particular year in the future, or that those historic factors which drove the market higher will necessarily be there in the future either. But that said, I think it's worth a look just to get a sense as to whether there is any evidence, strong seasonality, that tells us whether we should be buying in December. And in particular, what I'm going to be looking at is whether this applies to the S&P 500, maybe it applies to foreign markets or certain sectors of the S&P 500. So we'll come back to that in more detail in a moment. But first, I just wanted to emphasize, I really hope this video is useful to you. If you have found it useful, do please click on the like button. Do please click on subscribe as well, because it'll help other people find this video as well. So let's now dive right in and try and see, is there any seasonality in some of these stock indexes? So what I've done is I've looked at data that goes back to 1999 on a spreadsheet, and I've looked at the performance of the market over that 1 month from the close at the end of November to the last close at the end of December, and I've ignored dividends. So I've just looked at stock market close to see whether the market typically goes up, whether that's a frequent occurrence, whether it's rare, and what the performance looks like. So let's have a look first at the S&P 500, the main US stock market index. So here's the first graph of my findings. What I'm showing you here is the number of years the market has either been stable since 1999, whether it has declined more than 1%, or whether it's rallied by more than 1%. So by stable, what we mean is that it might have either dropped up to 1% or rallied up to 1%, but not moved strongly in either direction. So what we can see is that for something like 37% of the time, the market has been stable and hasn't done very much. It has declined by just over 20% of the occasions, and the number of years when it's rallied has been just over 40% of the occasions. So on the face of it, this looks pretty compelling. We would think that the most likely outcome is the market goes up, after that it's stable, and then finally the least likely outcome is that it declines. But I think we need to delve a bit deeper into some of this data here. Now, one of the reasons why we need a bit of extra caution on this data is that we know already that when the market sells off, it typically sells off aggressively and quite rapidly, and then takes a lot longer to recover. So is there the possibility, therefore, that when the market sells off, these are really big declines and they fail to offset the increases that we've seen in the good years. So let's have a look at the chart then. So here I've looked at the performance of the market in years when the market's stable, years when the market declines, and years when the market rallies. The top bar is when the market's stable, and as you can see, not a surprise, the performance is somewhere around zero. On the years when the market declines, the average drop has been more than 5%. Whereas on the years when the market rallies, the average gain has been just over 3%. So although the market might rally more often in December than it sells off, when it sells off, you get a rather more brutal decline. What this means, therefore, is that the average performance of the S&P 500 in December over this period is only up 0.2%. Now, that's not a reason to say you shouldn't necessarily buy the market this particular year, but it certainly tells you that seasonality is not a terribly compelling argument to be long the index in December. There may be other reasons you might want to look into, but I'm not so convinced by seasonality. Well, it might not work for the index as a whole, but let's look at one of the subsectors. Let's try utilities and see what the same graphs look like if we look at the utilities available in the US market. Here's the same chart for utilities, and you can see the proportion of years where the market's stable, it's not very high, it's only just about 20%. It sells off slightly more frequently than that, just under 30%. And again, just like the S&P, it rallies more often, and in fact it rallies nearly half the time. So on the face of it, you might be thinking utilities again should present a good seasonal opportunity. Now we've looked at the performance of the market in the years when it's been stable, when it's sold off, or when it's rallied. So in the years when it's been stable, the performance isn't great, so you've actually lost just about 1/3% there on average on years where the market hasn't moved very much. On the years when the market sold off, your average sell-off is somewhere just under 3.5%, which isn't great. But the good news is that in the years when it rallies, the amount it rallies is, again, just under 3.5%. So for utilities, there's a much more symmetric performance in down years when they're compared to up years. And what this means, therefore, is that the average return over the whole period for utilities in the month of December alone is somewhere around 0.7%. So actually the seasonality argument is slightly more compelling for utilities than it is for the S&P, as it looks like that sector, when it has sold off in December, hasn't sold off nearly as much as you might have expected. So perhaps there's a more compelling argument to be drawn for utilities. Let's now look outside the US and have a look at another stock market index. Let's have a look at Japan to see how the picture for Japanese equities looks if we analyse it the exact same way. Here's the same graphs again for Japan, and you can see that the market is stable for a bit less than 10% of the Decembers under study. It's declined in December nearly 30% of the time, but it's rallied in December by more than 60% of the time. So on the face of it, for Japan actually, it does look like a more attractive proposition that it does rally that much more frequently at the end of the year. And if we look how the market's performed in the stable years, the down years and the up years, in the stable years, it's just up slightly, not very much. In the years when the market's gone down, you're down somewhere approaching 5% or thereabouts, whereas in the years when the market's gone up, you're up by somewhere around 5%. So there's quite a symmetric performance between the up years and the down years. That was more like utilities in the US, but it certainly contrasts quite considerably with the overall US market. This means, therefore, that the performance of the Japanese market in a December, on average, is up 1.1%. Rather more than utilities in the US, and certainly rather more than the US market. So yes, it does look like there are some seasonal factors at work during the month of December in some markets, and they're more powerful in some markets than in others. So maybe you want to incorporate that in your trading strategy. It depends what you're trading. And of course, you don't have to just look at this in December. You can look at it for other months. Certainly there are people out there who believe that October or September can be pretty bad months for the market. So you can look at this at any time of year. If you have particular thoughts or you want to try this in different markets, put some comments below and I'll try and get back to you. So I've got a spreadsheet where I can easily calculate the performance of these different markets for different periods. You may also want to consider that certain periods of time may be more relevant than others. Perhaps data since the global financial crisis is less relevant or more. That's up to you to decide. But certainly, I think this is something worth looking at. I don't think it's a reason in and of itself to buy a market because you think the seasonality factors are so compelling. But I certainly believe it is one thing that you might want to look at. And if you've got time, worth building your own spreadsheets to have a look and see for any month for any market which are most driven by seasonal factors. So I hope that was useful. Please do like, please do click subscribe as well, and I'll be putting some more videos up in the coming week. Look forward to seeing you then.